Good afternoon, everybody. Thank you so much for joining us. My name is Mark Friedenthal. I'm the founder and CEO of Tolerisk. For those not familiar with Tolerisk, we provide risk tolerance technology designed specifically for the fiduciary process. So it's not just a personality profile, but also incorporates financial data to measure your client's actual financial ability to take risk over time. If you have not seen Tolerisk recently, please reach out to us. We're happy to schedule a demonstration so you can see how advisors use Tolerisk to accelerate practice growth and reduce compliance risk. And if you haven't seen it yet, check out the 2024 T3 Inside Information Survey of Advisor Technology, where Tolerisk has outscored the big guys 3 years running and was named the all-star of the category. We are very proud of that. Anyway, enough of my shameless plug as your sponsor. I am very proud to introduce our thought leader speaker for this afternoon. Frank Anguiano is managing partner at Alcanza Global, a leading boutique consultancy in the global wealth management industry. He serves as a trusted advisor to executives and delivers strategic advice to private equity sponsors and asset managers. Prior to this role, he was the head of investment products at UBS Global Wealth Management. He led product development, platform management, strategic partnerships, and product strategy across both corporate and institutional clients in the U.S. He was charged with managing an integrated product experience and distribution of investment products, such as alternative investments, structured notes, capital market solutions, and banking and lending solutions. Prior to UBS, he held multiple roles across trading, structuring, and sales within global capital markets at Morgan Stanley, and was an integral contributor to the joint venture between Morgan Stanley and Smith Barney. In addition to this very impressive CV, Frank is also an invaluable member of the advisory board at Tolerisk. So we are so privileged to have Frank with us today. Please, please, please share your questions for Frank by typing them in the box. We will relay them for everyone to hear. This will be most fun if it's interactive. So let's get some good audience participation. And for those of you submitting CE credit, I do see a question about that. Please stay engaged and attentive for at least 50 minutes. The question, I think, is this investment approved? So it's not the question I'm seeing here is this investment approved by Osaic broker-dealer for us to use with client portfolios? I'm not sure it's an investment. So if you're talking about Tolerisk software is used by Osaic advisors. It's been vetted by various units that are owned by Osaic. So I think Securities America, American Portfolios, others as well. So I don't think you're having an issue there. Tolerisk does not provide investments, nor does Alcanza Global. So with respect to the question that we're receiving, we can take that offline. So I apologize for the yes, Frank is going to speak about alternative investments. We're going to get started momentarily. We're getting the questions are coming in. So we are very privileged to have Frank here with us today. We are going to talk about alternative investments. That is one of several specialties that Frank has. And without further ado, please join me in welcoming Frank Anguiano. Frank.
Thanks so much, Mark.
How are you doing
today?
It's a
privilege to be here with everybody. It's a great opportunity to take and see so many advisors here with us. And also, this is a very timely topic. As we all know, alternative investments is top of mind for a lot of folks, clients, advisors, and advisory firms alike. So, perfect timing to dive deep and think about all of the different nuances, how to position the product set, how do we think about it as an asset class, and ultimately, what does it really mean from a practice management perspective? And as you mentioned earlier, Mark, please do put in some questions. Happy to answer any of the specifics. From our perspective at Alcanza, we sit at a very unique intersection of not only what I'll call solutions and products, but also the relationships that we have with asset managers and private equity firms. So myself, I work very closely with a lot of private equity firms that are active in this space, i.e. investing in wealth technologies that are out there or providing solutions with their portfolio companies. And on the other side, we see what asset managers are building behind the scenes and what they're trying to bring to market. And from time to time, we also help them with their go-to-market strategies and think about distribution, placement, and there's the true need for what they're delivering. So we see a little bit of everything, and we're happy to share some of those thoughts today.
So we have lots more questions coming in. Keep writing your questions. I will absolutely get to all your questions, but I also have some questions as well, and I want to make sure we're also kind of grounding everybody in this topic. I know that the term alternatives has really evolved over the years, and I think it might be helpful for this group if you could just sort of ground us by defining alternative investments in today's context.
Great. And that's a great place to start, because just the term alone, alternatives, a lot of times carries a little bit of a negative connotation depending on who you're speaking to. And people have normally defined it as anything that is not traditional, i.e. your stocks, your bonds, sometimes just your ETFs and your mutual funds. When the way that we view it is very particular to what I'll call better defined around private markets. And so this traditionally is more private equity vehicles, private credit vehicles, infrastructure, real estate. And the reason that we created, or we think about it in this subset, is because ultimately when you compare it to other type of vehicles that are out there, i.e. hedge funds as an example, or sometimes even crypto assets are put into this mix, it starts to get a little bit unruly. And what you see, especially from a lot of the larger asset managers today in the industry, is they're really focusing on this smaller subset because, number one, there's easier to implement within a portfolio. Number two, they carry a lot of weight when it comes to true portfolio construction capabilities. And then lastly, those are, we'll call it strategies and vehicles that are more tried and true. So while many folks may just be hearing about it for the first time, there's nothing really new around a private placement structure, that's been around for the last 50, 60 years. So from that perspective, the definition itself just encompasses what vehicles may be included and versus excluded. And today, for purposes of our conversation, we'll really be narrowing down the scope into what we define as private market vehicles. And just to carry on to that piece of the conversation too, as I mentioned earlier, a lot of times it does carry this little bit of a negative connotation. And when we speak with financial advisors and their clients as well, we sometimes try to avoid the term alternative investments altogether and just position we'll call it the vehicles more aligned to what their objectives are. So what is this private equity vehicle looking to achieve, the differences between public and private, and ultimately, what does that mean when you align it to a client's risk profile, and even more importantly, a client's liquidity profile, which I'm sure we'll touch on in a little bit.
Yeah, so you touched on something that one of our advisors asked, which is, do you count crypto as an alternative? And which, by the way, begs the question: is it an asset? Is it an investment? Is it a currency? You get a lot of differing opinions. So maybe you could give us your thoughts specifically on things like Bitcoin.
Yep. So I think things like Bitcoin, just digital assets in general, they do serve a purpose within the client's portfolio. Ultimately, they are investable assets. To the degree of how much it's invested versus how little is invested. The canned answer is really comes down to the client's risk and needs. The way that I personally view it, and how we've positioned and we built portfolios around digital assets, Bitcoin in particular, is where is beyond just thinking about it as a store of value, a currency, a commodity, is what are the risk attributes that this is delivering to the portfolio, and also at what point does it become meaningful enough to be a driver of those returns. I think a lot of people like to dip their toe in the water and test it out a little bit, see hopefully it doesn't blow up. And I think with some of the latest news that we see coming across the headlines, where it's hitting $90,000, is starting to pick up. The FOMO trade is starting to pick up again. So I wouldn't be surprised if you hear more and more clients asking about this piece of, we'll call it the alternative investments landscape, more often. And I'm sure, like I said, it will be a growing piece in the future. The exact allocation really comes down to the client's portfolio, risk and needs, and other, we'll call it type of liquidity profiles. But at the end of the day, it will have a piece. So
you've touched on you've used the word portfolio a couple times, and I'm curious, especially having spent the bulk of your career at two huge wirehouses, where historically this concept of suitability applied at the instrument level. You
Hmm.
know, you look at Jane Doe or John Doe and you say, is this particular investment suitable for this client? And it was viewed historically in isolation. You've talked about portfolios. We cater to fiduciaries, so most of our advisors are RIAs or are hybrids, dual registered, and have a lot of RIA business. So when you think about alternatives, private markets, when you think about these in the context of the portfolio, how do we kind of square that circle where the legacy wirehouse broker dealer methodology was, is the instrument in isolation appropriate for that client? Whereas when you talk about it as a portfolio, which I think is how our advisors typically would look at it, they're saying we could put very risky assets inside, call it a conservative portfolio, as long as the size, the weights
Hmm.
are perhaps small. So how do we reconcile sort of these two different views of appropriateness, and especially in the context of alternatives where this is an evolving kind of landscape?
Well, I will say, based on my history and my knowledge of how, the internal mechanics of a wirehouse work, a lot of times they do operate, as you mentioned, towards what I'll call the lowest common denominator, and they're really trying to put as many bounds and boundaries around all facets of the investment process. So it's a little bit more, we'll call it compliance minded or liability minded as a result of that. But as these new asset classes are growing, there's a greater need not only for clients to have that level of diversification in their portfolios, and people are starting to realize that, we'll call it, the traditional tools that have been made available may need to be reevaluated. And as that starts now to get to what I'll call to the phase two of this growth, now there's an appreciation that it no longer has to be this very linear type of mapping exercise that has to happen at a client's portfolio. There's an appreciation that ultimately, these assets, when they're mixed together with other assets in a portfolio, can achieve the desired outcome. And that's really what it's all about, right? Making sure that the combination of these assets, whether they be risky or not risky, and that's a whole other, we'll call it, conversation to have around how do we define risk, ultimately are designed to meet that specific client's goals and objectives.
Well, it raises another related issue, right? So if you're measuring the risk of the portfolio,
Mm.
you kind of have to have data if you're going to see how these instruments interact with each other. Part of the use case for alternatives is that they don't react like perhaps broad public stocks or bonds or things like that. That it's diversifying, right? If we're expected to be the same as the things everybody already had access to, then it wouldn't really have some attractive place in a portfolio. So how do we wrestle with the fact that private investments don't have the same data availability of public investments? And how do we overcome that when we're trying to now measure the risk of a portfolio so we can see how adding some portion of private alternatives impacts that risk level for that client?
Yeah, you hit the nail on the head. Data ultimately leads to better transparency, better evaluation of risk of within that portfolio and return, right? What taking a few steps back around when we started talking about the definition of alternatives, I view one of the key defining factors of alternatives really around the liquidity spectrum. On the public equity side, obviously those are more liquid vehicles versus the private market side. And in order to really achieve the value that is promised from private market vehicles, generally speaking, there has to be enough quote unquote time in order for you to achieve that liquidity premium that hopefully ultimately turns into alpha, generating the proper returns for the client. The data side of things, in my personal opinion, there's been a lot of strides to improve transparency for the ultimate holder of it. But because these are structured as contractual agreements, many times those we'll call it parameters or metrics of measurement are exclusive to that specific client. And I can give you a really interesting example. You know, we come across some ultra high net worth clients that may have relationships with different types of advisors and may see different types of vehicles coming from the same sponsor or from the same asset manager. And sometimes what you come across is the fees and expenses associated with the same fund may be slightly different. And that has to do with how the product is distributed, ultimately who is purchasing the vehicle as well, how it's being purchased. So these small nuances ultimately lead to differences in return. And that could be something as simple as how expenses are calculated, or you know, sometimes if it's a more brokerage related product versus a managed accounts product, you know, how commissions are taken into account. So you know, needless to say, there's discrepancies there, even at the individual client level, which makes the data aspect more difficult.
To me, that's the small stuff. To me, that sort of smells like different share classes of mutual funds, meaning
yes.
Meaning it's not really pertaining to the risk. It's not changing correlations to other asset classes. It's not changing volatility. It's not changing drawdowns other than the subtle differences in the expenses. So I feel like the industry can overcome that. What I think we ultimately need are monthly marks. And whether or not, I mean, look, you could have monthly marks that might not be reliable. So I suppose it's more than just having monthly marks. We want to have monthly marks that somehow are indicative of where the assets could be bought and sold. And I don't know how close the industry is to having that for these private investments. Certainly seems like we're moving in that direction. I know for us, when we measure the risk of a portfolio, to make it easy for the advisor-client conversation, we're putting it on that standardized stocks to bonds benchmark scale. Now, that doesn't mean you can't put other assets in there. And things like Bitcoin are easy to put in because we've got publicly traded securities that hold them and track them. And with private securities, I watch advisors use proxies. They have a private REIT, they pick a public REIT fund, you know, and that's okay. It's not ideal. I'm hoping that the industry is continuing to advance, and we're going to get monthly marks on these kinds of alternatives. Maybe you could talk to sort of how you've seen this evolve in the last couple of years. What kinds of trends are you continuing to see? Are my wish list items of getting these more reliable monthly valuations? Is that are we months or years or decades away from that?
Not decades, definitely not months, but I will say it's going to probably take a few years. And a lot of that has to do with just the standardization of how it's reported. And, you know, today, just take a very simple example where a private equity company has a portfolio companies that they've invested in. You know, they may have different timeframes in terms of when those specific KPIs or financial metrics may be reported on their end, which leads to discrepancies at the fund level, and then ultimately leads to lags and delays at the valuation side of things. And we see that very often with even some of the larger funds. And you know, when you're talking to some of the smaller managers, they a lot of times, unfortunately, don't even have a process in place, and their marks tend to be even with a more significant lag. So the the standard so far has been try to achieve at least a quarterly mark, which we know that that becomes stale very, very quickly because it's already stale at the time that it's marked.
Right.
And but I do see there being progress being made, trying to get the KPIs, trying to get the financial statements and reporting documents from the individual portfolio companies in a more timely, readily available manner to the private equity sponsors, because ultimately it's also in their best interest to ensure that they have good visibility into the operations of that firm, right? And I think just more, you know, globally speaking, what you start to see is these firms are targeting operational processes as their value add versus the traditional 1980s financial engineering methodologies that were out there. So long-winded way of saying is I don't think it's happening in the next couple of months, but we're not that far away because more technology is being used at both the portfolio level, at the fund level, at the sponsor level, and ultimately that obviously provides data to custodians and transfer agents and ultimately down to client portfolios.
We've had several questions about changing regulation and specifically as it pertains to alternatives. And so what I'll try to combine a few of these. Does less regulation help the space that is alternatives? And do we think that we are going to be in a period of less regulation? I think perhaps the intimation might be related to the recent election. Do we think that deregulation is likely, and is that going to help alternatives? Let me pose it that way.
So I'm of the camp that we may actually be at a status quo. I don't think we'll lean in one direction versus another because regulators ultimately are looking, going back to 2008 Dodd-Frank era, they're saying, some of these policies that we've put in place are working, i.e. we've quote unquote de-risked the banks. They're no longer levered, 20, 30 times, and ultimately are distributing a lot of that origination risk to private markets, and whether it is insurance companies, institutional clients, or individual clients through financial advisors and financial advisory firms. Ultimately that system that was put in place was by design and it's working. So my personal opinion is that we don't see a change one way or the other. And I think just piggybacking off of that, I think that's actually a good thing. You want these markets to work, and I know obviously there's a lot of negative headlines around: are we in a bubble? Have markets gone too far? There's a lot of excitement behind this. So is this another, we'll call it FOMO trade that's happening? And we just don't see that. When you zoom out a little bit and just compare private markets versus public markets, you start to realize that if anything, there's probably more risk in the public markets as a result of either concentration or just fewer public companies out there. There's some stats going from in the last 5 to 7 years, there were about 8,000 companies down now to about 4,500 publicly traded vehicles that are out there, which is significantly lower than the amount of demand that is out there to be traded around these vehicles. So I think it stays where it is today.
So when we think about the fund industry, whether they be mutual funds, exchange traded funds, open, closed end, so forth, there are more funds than there are securities to put in them, right? Which is
oh yes,
a whole other topic, I suspect. Some funds are much more liquid than the instruments they hold. We've seen it in lots of areas. Is alternatives an area where, are we seeing more of that? Can someone buy their alternative exposure inside some fund structure that gives them a level of liquidity that they can't get by trying to access those individual private markets? And should they, for your typical investor, should that be the way they get their exposure to alternatives?
The capital markets never cease to amaze in terms of the innovation and the financialization that occurs. Ultimately, there's demand for those products, right? And even though it may seem like there's you're in a situation where the tail is wagging the dog, it happens very commonly, believe it or not, in a lot of the derivative products that are out there as well. Whether it's in futures or more commonly even in VIX strategies around the equity market. So, my perspective is that those ultimately become a market unto itself, and you have different use cases behind it. Some folks may use those vehicles for true hedging, as an example, or diversification, but the real usage comes out of folks that are looking for allocations, and as long as there's demand, there's going to be liquidity, and there's going to be a growing market behind this. And
So
then just the last,
yeah, go ahead. Sorry, please.
And the last piece, I think this also just speaks to the growth around ETFs and just general packaging and wrappers that are associated with it. Those products have ultimately simplified the investment process for a lot of people. And even though it obviously, from our perspective, it leads to a lot of concentration and double counting in some respects, or triple, quadruple counting, it's achieving a certain need for clients. And that just goes back to my point that there's going to be continued demand, in my opinion, even though we're in that situation of the tail wagging the dog.
So we've talked about liquidity a lot. Obviously, that's one of the key risks when dealing with private markets with alternatives, is you're typically dealing with far less liquidity than you would have in public markets. Do we introduce another risk by wrapping them inside of a public security? So we've improved liquidity, right? Now owned by an ETF or something like this. Small investors can access them with good liquidity, with T+1 settlement and tight bid offer spreads that they can't get in private markets. But it would seem to me, as you said, these things take on a life of their own. There's supply and demand. Where does the ETF trade? Well, it trades based on what people are willing to pay for it. And so have we introduced this risk that the traded price of the fund gets detached from the value, from what we'll call it net asset value, if we can steal that principle? Normally in ETFs, when you're dealing with relatively liquid underlying, we have market participants that swoop in and arb out discrepancies, right? You can't have an S&P 500 fund that gets detached from the value of the underlying 500 stocks. Huge players come in, and for fractions of a penny, they're willing to step in and place capital to buy one and sell the other, and they all normalize. But that's not going to be the case with private markets. They don't have the ability to go in and just buy up all the collateral and sell the ETF. So I think much the way we sometimes see in closed-end funds, and some of these might be, they can really get detached. You can have a premium or a discount, and I'm just curious your thoughts on it. Have you seen it? Do you have any examples of ETFs or funds or closed-end funds that have experienced this? Does it tend to be in one direction? Does the allure of private markets tend to make those funds trade at a premium as opposed to perhaps waffling around a fair value? I'd just love to hear your thoughts on it. Oh, I can't hear you.
I'm in agreement that can you hear me now?
You're a little choppy.
Is that better?
Yeah, I can hear you, but I'm wondering if the signal, Jan, I'm not sure if you're hearing the same. Just want to make sure our audience can hear Frank.
Is that a little bit better?
It's very delayed from your video, unfortunately.
We'll try to reboot systems here.
Yeah, Jan's saying choppy for her too. So I'm sorry, folks. This is one of the symptoms of live television. We have to work through some of the kinks. We've all become so dependent on technology that when we get a little foible like this, it can be disruptive. Frank, you look clearer now. I'm thinking that maybe that's improved.
Okay, may have been, we'll call it a passing storm if there's any.
All right.
But all right, so hopefully you can hear me now. Just
Yes.
going back to your question, I'm in agreement. Unfortunately, this could be one of those situations where the industry has gotten ahead of their skis, and some of the innovation may be a little bit too innovative around just trying to slap an ETF wrapper on every new type of solution that's out there. And I simplify it down to the basics, right? Ultimately, you have assets that have much more longer longevity behind them, and again require time for the illiquidity premium to really manifest itself. And by shortening or getting access to liquidity via some of these other wrappers that are out there, it creates a mismatch. Now, how much of a mismatch? There will be growing pains. There will be, in some regards, maybe even a conflict of interest in terms of how these are managed and operated and underwritten, which would be, concerns from an investor perspective that I would look out for. But suffice to say, we haven't seen anything that is too disruptive in the industry yet. I know there's obviously rumblings of it, and from what we continue to recommend is ultimately ensure that the point of implementation, i.e. the vehicle, is number one, appropriate for the client, but also meets that need that we talked about a little bit earlier. A lot of times what we are seeing now is demand for evergreen products. So these are essentially perpetual investment vehicles that provide access at lower minimums, lower thresholds, and reduce a lot of the operational complexity that is out there relative to a typical drawdown fund. And these have increased in a lot of popularity as a result of just better access. So those I still think are great vehicles for, especially for folks looking to dip their toe in the water. And while they are bringing quote unquote some liquidity attached to them by we'll call it some rules-based approach, at the end of the day they're not an ETF, right? So the market is still a little bit separate and I think a long ways from being able to really ETFify or that product set.
Maybe you could touch on a few ways that advisors can best access alternatives for clients. I'm not talking about the uber ultra high net worth client, but for the advisor that's serving clients with a couple $100,000 to a couple $1 million, what's the best way for them to gain exposure to alternatives in those kind of client portfolios?
That's great. There's the interesting thing is that there's so many different ways, and I think the point around access used to be probably the biggest pain point for advisors of all shapes and sizes, probably up to maybe about 5 years ago. But with the prevalence of new technology platforms that are solutions based, it just become a lot easier to access. So there's the typical iCapitals of the world, the cases, the glass funds, the optos, and many more that I'm sure I'm forgetting, that provide not only access but also have digitized the subscription process for advisors, and therefore relieving a lot of the burden that came from managing paperwork and ensuring that ultimately that their subscription was taken by the asset manager. So this has alleviated that pain point significantly. And I would actually argue that it's no longer a question of why or even how to get alternative investments. Now it's how, like the pain point is around implementation and life cycle, in my opinion. So what does that mean? That means after I've purchased or subscribe to this investment, how do I manage capital calls, or how can I think of distributions, and what does that mean to my client's liquidity profile, and how does that match up with maybe some of their demands that they may have from a cash or liquidity need perspective. So those type of pain points we're starting to see more, also side by side with some of the traditional, we'll call it K1 reporting and valuation issues that have always been persistent in this space.
So So go a little further for me. When you say capital calls, you're talking about a private investment where the company has the right to demand more capital be put in from their existing investors. Is that what we're talking about?
That's correct. And even taking a little bit of a step back, the concept of capital calls and essentially even having an initial contribution and your initial contribution not being completely invested day one, that's even a foreign topic for a lot of clients because when your client gives you $10 million to invest in Apple stock, it's immediately invested, right, after
But
execution.
is the client putting forth the money, the cash that could be called, or is it possible that the client could be in a situation where there's a capital call and they literally can't meet it?
So that introduces a whole other level of complexity. And that's what I call liquidity or cash management when you're going through a private markets, I call it journey. Because ultimately to really fulfill the allocation of private markets within a client's portfolio, it's not just a one and done trade, right? It's not just saying I've invested in this one PE fund or feeder fund or private credit vehicle, and I've checked the box when it comes to addressing a client's need for diversification or returns or complementing their income. It's really a journey. And by that, I mean, you have to have diversification within that allocation of different vintages, different managers, even sometimes geographies, depending on what you're looking to invest in. So there's different degrees of how sophisticated you as an advisor may even want to get. Suffice to say, though, that obviously the more complex the relationship, the more we'll call it technology would be required in order to help you manage those capital calls and distributions and ultimately better manage the investment vehicles and the timing of those investment vehicles as well.
Are there any unique tax consequences for alternatives that advisors should be aware of?
Very much so. And traditionally, drawdown funds will carry a K1. And I think that's part of the reason you're seeing a major adoption around the evergreen type of vehicles because clients don't necessarily have to operate waiting for that K1. They just receive a 1099, which is more akin to their typical investment experience today. Also, from a reporting standpoint, it's easier to get marks into client statements, and that aligns a little bit closer to the values that they see within their overall portfolio. And that's just not the case with the traditional drawdown structure, which carries a little bit more onerous tax requirements and tax documentation. And usually what ends up happening is per quarter, you have a CPA that's probably calling you and saying, hey, where's the K1 for this investment? And unfortunately, you may have to make some calls to the asset managers and try to chase that down. Now, there's new technologies with a lot of the platforms that I mentioned earlier that they will do this for you on your behalf. And again, streamlining the client experience and the advisor experience. But traditionally that was the case. So the onerous nature of it is not something that I think anybody enjoys, but there are tools and technology that have alleviated that.
I'm going to put you on the spot, and if you don't know, we can always follow up with our audience later, but any cool tools, resources, specific things, websites, anything you can direct our audience to who are interested in more information about alternatives that you know off the cuff. If not, like I said, we can always send out a follow-up to folks that are interested.
Oh, I think first and foremost, the CAIA Association does a great job at providing everything from the 101, we'll call it informational brochures, all the way through deeper implementation. What I would also urge, anybody who has interest in this is you can reach out to your friendly neighborhood wholesaler at your nearest asset management firm, because they are all very well equipped providing tools and services around this. Each one of especially the larger asset managers out there, now they have portfolio specialists and product specialists, and not only providing, we'll call it the one-to-one type of brochures, but very in-depth, detailed information around asset allocation, how to think about it from a, we'll call it from even from a building a CMA or SAA or TAA part of your strategy as well, how to think about capital pacing. So those are two of the main ones.
When we thinking asset managers, are the TAMPs good resources for this stuff, or is it not that type of asset manager?
So the TAMPs today, they have access to, we'll call it the iCapitals of the world, the Cases of the world, and some of the others that I mentioned earlier. They do provide these resources. They are also a really great spot to get unbiased, we'll call it, information. A lot of times when you do go to a particular asset manager, they may be indirectly marketing or positioning their products to best fit, we'll call it, the educational materials that are provided. So, I would take that little bit with a grain of salt, but a combination of all of those, I think, is very, very well utilized. That you'll be in definitely in good shape. But Thai Association definitely has probably the most robust.
Excellent. When we think about risk, again, for simplicity, we're often talking about a stocks to bonds benchmark, even though we might incorporate alternatives, and obviously that may contribute to both the returns and the volatility of a portfolio. The time horizon for utilization of one's resources is a big driver, certainly in measuring their financial ability to take risk. Traditionally, legacy client risk profiling tools were personality based, and that's certainly an important element. As I know you know, and many of our audience know, what Tolerus has done differently is solve that problem of being able to incorporate the client's financial data, and that enables them to integrate that into the financial planning process. It also enables us to measure the client's financial ability to take risk, which is part and parcel to the timing of utilization. So in the context of alternatives, what's the time frame, less from a volatility standpoint, perhaps the way we would with the stock market, but more maybe from a liquidity standpoint, what's the time frame that advisors and clients should be thinking about holding private market investments because of liquidity risk? Because if they have to get out, A, they might not be able to, or they may be doing it at a compromised valuation.
Yeah, I think you hit the nail on the head. There's a very, we'll call it a inextricable link between time horizon and liquidity. And making sure that there's alignment to the client is probably the utmost most important thing I can stress after this call. The way that we view it is taking it back down to basics, even within a financial planning context. I know a lot of advisors today, they look at a client's whole net worth, not just their investments, but also including their liabilities, as an example, and pulling in an assessment of what is the liquidity needs for that specific client. There's different ways to approach this. Different advisors have used, some use mental accounting behind this, some use a bucketing strategy that first defines, what are those, immediate needs in the short term, call it 0 to 3 years, being able to allocate towards that. Anything beyond that, and let's just say a earmarked goal within that time frame, or maybe within 5-year time frame, beyond that would be used in a different bucket that would be geared towards generating returns for their retirement, as an example.
So is 5 years the right hurdle to be thinking about most alternatives? And obviously it varies based on the individual instrument, so I know we can't do it with one sweeping brush, but is 5 years, is that about the right kind of time frame, or do we have a material part of alternatives that might require a longer holding period to really reduce the risk that they might have to dispose of it at an inopportune kind of level?
Yeah. So what we've been advising advisors on is looking at it a little bit beyond that 5-year threshold. That 5-year threshold just assumes that you have a fully allocated, fully invested portfolio that's already fully diversified across vintages, and you are already receiving distributions from we'll call it prior vintages or prior investments. So usually in practice, as you're ramping up, it's probably more realistically about 10 years. And then that ramps down maybe to about an average of 7. And then once, again, you're more involved with, or more further down the line in your private markets journey, then it actually becomes closer to a 5. And that is an interesting threshold because, number one, that a lot of clients tend to have visibility in terms of goals up to that time frame. Anything beyond that tends to be more either retirement related, or we'll call it has a very strict accumulation strategy attached to it, which now forces a different type of liquidity profile to be addressed, right? And at that point in time, maybe have to have other considerations around how accessible liquidity would be if there's a specific need that may come up. So bottom line is, as we start to do evolve some of that mental accounting, and we go down this bucketing strategy, that first bucket is really defined as the near term. The second bucket is really targeted on the long term investments that don't need to be touched, especially around market cycles, and that tends to help advisors better address the emotional concerns that clients may have during down markets, especially. And then the last bucket just tends to be more around building, we'll call it a long-term strategy for legacy purposes, i.e., estate planning, or giving to philanthropies or charities, or anything else that may be outside of that individual client's immediate needs within their lifetime.
You mentioned estate planning, and I can imagine, when somebody passes and their heirs are given a stepped up cost basis of assets that are transferred, we introduce a whole other element if we have something that has quarterly marks. I don't know that mom or dad necessarily passed on the 31st of whatever quarter or month they're in. So I can imagine that there's probably some burgeoning exercises about how do you even establish what the stepped up cost basis would be for something that's private. I don't know if you've seen any precedent for this kind of thing. I'm sure it exists. Any thoughts on what people deal with when advisors are working with clients who have assets transferring between generations?
So interesting enough, this specific use case is not something that we personally deal with, but the exercise of being able to provide what I'll call an ad hoc valuation or market price or estimated NAV is something we're extremely familiar with, because a lot of times that also occurs with banks that need to get transparency for one reason or another. Custodians are also going down that path, insurance companies, and ultimately, the real reason behind it tends to be estate planning or a death related event or something along those lines. So bottom line is it is an area of focus for us. The way that we view it is today, we try to take a page from what some of the larger pension funds and endowments do, just given their outsized exposure to private market vehicles and history behind it. And the way that they operate is that they hire 2 to 3, sometimes 4 different auditing firms to provide them a valuation of those funds. Now, not feasible for the average client.
That sounds expensive.
Exactly, right. But from their perspective, the reason that they do that is because they have to have a very good visibility into their liquidity profile, because at any given time, if there's a pensioner that's passed away, they have to have a liquidity event. So which is why they put so much focus on that, and their entire strategy is built around that. Now, for the average client, that's obviously not the case, and it just becomes cost prohibitive to even hire one auditor, to be honest, to do one particular fund or even portfolio of funds. We're exploring technology that helps streamline that and gives visibility down to the portfolio company, and takes 2 different approaches. The first is the tried and true approach that everyone's really done around a public versus private market comparable and the discounts associated with that. And then the second is something that we think it's a little bit more innovative around, I call a factor-based approach that creates a sum of the parts model, ultimately building up the underlying portfolios, building up, the underlying portfolio companies, looking at them sector by sector, we'll call it, what stage of the fund or investment cycle they're in, looking at what part of their maturity cycle they're in as well. And ultimately, this contributes to what we've defined as an estimated NAV. So this can be used as a quote unquote price, a mark, a valuation, with the banks and lenders that we work with today. And I'm sure, many more folks, like the use case you just brought up around maybe insurance companies or estate plans or trustees, may also be leaning to use this type of technology.
And at what point does a company like Tolerisk have access to that? Meaning, can we, with that type of technology, I can imagine when you start computing those values on a regular basis, let's call it month-end values, you are building this database that enables advisors using technology like ours or others to be able to incorporate those instruments and understand how they interact with the rest of the public securities that their clients own. I mean, we see such demand for that. And I would imagine there's going to be increasing demand. I mean, look at the companies that used to go public that are staying private, or look at the companies that are public that are going private. I mean, there were a couple recent ones, right? InvestNet, AssetMark, aren't they two recent ones that were public and going private? I'm sure there are others. This is going to keep getting more, and it's going to keep seeing more and more demand.
Yeah, data is gold. Data is the new oil. Obviously that's been said before since 2010, but now in the alternative investment space, you can see the transaction with BlackRock buying Preqin as a really good example of what data is worth to them, and ultimately private market data that will maybe propel some of their endeavors around building portfolios or products that are maybe ETFified in the future. So I am in agreement with you. There's going to be demand. There is demand, and there's going to be many more use cases that are going to come from it. The first use case, as you mentioned, is a lot of advisors are just looking to get a better understanding of what this is relative to what they know and what they own. And there's many firms that are making strides in this, not just the data companies. Some of the asset managers are also thinking about how to more readily make readily available data for their specific products to alleviate some of those pain points for clients and advisors. So it's a trend that is, I think, only going to continue. And I think in the short term, probably there won't be a one size fits all for anybody, and there will be many different players. So as a client and advisor, you may have to sift through figuring out which ones is the right one for you, which is the most reliable price or vendor for you to receive that data from. But in the long term, I think there's going to be some standardization that gets everybody very, very close to whatever that market quote unquote price may be.
Let's pray it comes soon.
Yeah.
All right, I can't believe we're almost at the hour here, so we're going to wrap up momentarily. Just for fun, anything you can think of that you think might surprise people in the next 6 or 12 months in the space of alternatives? Anything we should be on lookout for that we might not be thinking of?
I think driven by regulatory changes, that you may start to see private market vehicles be included in retirement accounts. And that opens up the door to another 12 to 13 trillion dollar market that could be extremely significant.
Well, to your point, we've already seen 40 Act funds based solely on private investments. So I mean, they're setting the stage for it. I don't know. I don't know enough about all the different plans out there to know if somebody's utilized it. I would think it might not be that far-fetched, but certainly the stage is set. So we'll have to keep our eyes open for that. Before I let you go, I know Alcanza is used to advising and assisting generally larger institutions. For our individual advisors, are there things that they should be asking their corporate RIA or BD affiliates that they should be doing with Alcanza? Are there things they, as individual advisors, should be looking to Alcanza for? Tell us how our community can best interact with you and gain from the kinds of insights and information that you publish and put out there.
First, I'm very accessible, so you'll speak to everybody and anyone. I'm very accessible via emails. It's just frank@alcanzaglobal.com. So happy to speak with anyone. Secondly, we work with all different types of firms, addressing not only their what I'll call product needs, but also their strategic growth needs. So we see this being, interesting enough, one of those pillars of growth that financial advisor firms use, and we like to see that mix and help out wherever we can. When it comes to some of their larger firms, we may already have some relationships, so don't want to step on too many toes, but obviously feel free to plug us in. And then just the last thing I'd probably bring up to a lot of folks, I know we didn't touch on this today, but due diligence in terms of being able to identify the proper manager and a proper investment vehicle, I think is paramount as well. So there's the work that the financial advisor has to do with their client, and that's the profiling work, understanding their risk tolerance, their liquidity tolerance, matching that, aligning that with the product type. But ultimately, the level of work and sophistication also that's needed around understanding, is this the right manager? Is this manager doing what they said they're going to do? And does that meet my client's needs? That's also another level of expertise that's required. So I strongly recommend, ask those difficult questions to whoever is performing due diligence on, for your firm or on your behalf, because ultimately that is going to be probably the main determinant of returns. And again, aligning that with the client's needs and liquidity profiles is ensuring that you have the right success and the client's needs are being met.
Excellent. Listen, I can't thank you enough for doing this. I know that advisors from around the country, around the world have tuned in to see you, and I appreciate it. We've had tremendous questions. We had a lot of questions. I know I said I was going to get to every question, and so now I have to apologize and eat crow that I did not get to 100% of the questions. So if your question did not get answered, I do apologize, but we can get you in touch with Frank, and so just feel free to reach out. You said Frank at Alcanza Global, ALCANZA global.com. Is that right?
Yes.
And we'll get you guys connected. So we do want to thank you all for being here. And for those of you that stuck around, you will get your CE credit as you requested. Thanks so much. Again, Mark Friedenthal for Talarisk. I really appreciate everybody being here. Yay. And Frank, thank you especially to you for doing this. We appreciate your expertise and your time, and look forward to hearing more from you in the future.
Thank you all.
Bye.
Bye-bye.